All right, let's do this. Feeling ready to tackle the stock market.
Always.
So today we're diving deep into Finance Unlocked, stock market basics
Okay.
with Jordan Lee, who breaks down everything from how the market actually works to how people make money from it, which I know is what we all want to do.
Yeah, he starts off with this really cool analogy. Compares the stock market to like a farmer's market.
I love that.
I know, right? Like super simple way to explain this, kind of complex system.
Yeah, so instead of picking out your apples and your peaches, you're buying and selling pieces of companies, stocks or shares.
Right, right.
But what's in it for the companies themselves?
Yeah, it's a great question. So for companies going public, listing their stocks on exchanges like, the NYSE or NASDAQ is how they raise money or capital to actually grow their business.
So basically, selling a part of themselves to fuel their expansion.
Exactly. And for investors, it's a chance to buy into that growth, hopefully, profit if the company does well.
So if the company's killing it, their stock price goes up,
Right.
and investors can sell their shares for a profit. But
Exactly.
Jordan emphasizes that it's not all about, just the company's actual performance emotions play a big role too.
Oh, yeah. Huge role. I mean, think about it. Like, if there's a ton of buzz around a company, people might rush to buy the stock, like even just based on rumors,
Oh, yeah, yeah.
and that drives the price way up. But then the opposite happens too, right? If there's fear, uncertainty, people can start selling off like crazy. The price plummets even if the company's, fundamentals are strong.
So it's almost like a psychology game in a way.
Yeah, yeah, totally. Like investor psychology is huge in the stock market.
Speaking of psychology, what about those terms we always hear, bull and bear market?
Yeah,
It all ties back to the sentiment, right?
exactly. Jordan describes them really well. So a bull market, like picture a charging bull, it represents optimism. You know,
Yeah.
prices are going up. We saw a massive bull market in the late 90s, the dot-com boom.
Oh, yeah, yeah.
Everyone was like pouring money into internet companies.
Crazy time.
Then you have the bear market. Think about hibernating bear represents fear.
Yeah.
Things are slowing down, prices are falling. Like during the 2008 financial crisis, that was a definite bear market.
Oof. Yeah. Vivid examples for sure. Okay, what about another term Jordan breaks down?
Okay.
Dividends.
Okay.
He uses this analogy of getting rent payments for owning a piece of a building,
Yeah, it's so good.
which I thought was super helpful.
Yeah, basically companies that pay dividends are sharing a portion of their profits with their stockholders. Usually it's like a quarterly basis. It's a way for investors to, earn passive income from their investments.
So you're getting a little reward just for holding on to the stock.
Yeah, exactly. It's a nice bonus, especially for those long-term investors.
Okay. But what about when a company first decides to go public? They don't just magically appear on the stock market.
No, no, they don't. There's a process for that, and Jordan explains it really clearly. It's called an IPO, an initial public offering. That's when a private company decides to, sell its shares to the public for the first time. It's think about it like a new fruit vendor showing up at that farmer's market we were talking about,
Right.
right?
Oh, okay, I see it.
Suddenly, everyone's curious, wants to try their produce. Could be amazing or a total flop. You never know.
And just like with that new vendor, the price of the stock can fluctuate wildly during an IPO. It all depends on the demand.
Exactly. And a recent example, remember when Airbnb went public in 2020?
Oh, yeah.
Everyone was talking about it, and the stock price, like, soared.
Big time.
It was a hot IPO for sure.
Definitely.
Now, speaking of buying a variety of fruits, Jordan also goes into this concept about, diversification.
Okay, yeah.
He talks about ETFs and index funds, which are basically baskets of stocks.
So instead of putting all your eggs in one basket with, that new fruit vendor, you spread your investment across a bunch of companies, like different sectors even.
Exactly. And index funds, for example, track specific market indexes like the S&P 500,
Okay.
which includes like 500 of the largest U.S. companies.
Wow.
You're instantly diversified across like a whole range of industries. ETFs are similar, but they can be even more specialized, right?
Okay.
So you could have one that focuses just on like technology or healthcare.
So diversification helps to kind of manage risk because if one company or sector isn't doing well, your whole portfolio doesn't go down with it.
Exactly. Exactly.
Okay, got it. Now, the million-dollar question.
Literally.
Literally, how do people actually make money?
Okay, so Jordan outlines two main ways to make money in the stock market. Capital gains
Okay.
and dividends. So capital gains are when you sell a stock for a higher price than what you bought it for.
Okay.
Like Let's say you buy a share of company X for $50,
Okay.
and later you sell it for $100. You've made $50 profit.
It's like the classic buy low, sell high.
Yeah, yeah. And then dividends, remember, those are like those rent payments we talked about. You
Yes.
get those just for owning the stock, whether the price goes up or down.
Nice little bonus.
Yeah.
So I guess it's about choosing companies that you think are likely to grow in value or that pay out those consistent dividends.
Well, it's a bit more nuanced than that. Jordan really emphasizes that, the stock market, it's not some kind of get-rich-quick scheme.
Right.
There's inherent risk involved that you could just as easily lose money as make it.
Yeah, for sure.
He really warns against trying to time the market, which is basically trying to predict when to buy and sell to, maximize profits.
It's almost like, going to the farmer's market and trying to predict like which day is going to have the cheapest peaches.
Exactly, yeah.
Yeah. And chasing those like, those hot stock tips without actually doing your research is just as risky.
Totally. Like buying something just because everyone else is without even looking at what it is.
Okay. So before we all run out and like, buy a ton of stocks, what are some common mistakes beginners make?
Well, one of the biggest ones Jordan points out is trying to time the market, right?
Yeah.
And then there's the temptation to chase those hot tips without actually doing proper research. It's easy to get caught up in the hype, especially like online.
Yeah, yeah. Like seeing a long line at food stall and assuming it's got to be the best, but you haven't even checked the menu.
Exactly.
So instead of trying to outsmart the market, Jordan's like, emphasizing a more long-term strategy,
Yeah.
one that's based on research and informed decisions.
Absolutely, yeah. That brings us to like, those first practical steps. Anyone who wants to start investing, the very first step is self-education.
Love it.
Like read books, follow reputable financial news sources, really understand the basics before putting any money down.
Okay, so no jumping in head first.
No, no, no. But once you've done your homework, how do you actually buy stocks?
Hey, you don't just walk into a bank and say, give me some Apple stock.
No, unfortunately not. You need a brokerage account to buy and sell stocks.
Got it.
There are, like traditional firms like Fidelity.
Yeah,
But nowadays you have all these user-friendly apps
right.
like Robinhood, which makes it super accessible, especially for beginners. And to make it even easier, you can start with fractional shares.
Fractional shares, I haven't heard of that.
Yeah. Yeah. So instead of buying like a whole share, say, of something like Amazon, which could be, quite expensive, you could buy a fraction of it, like, a tenth
Oh,
or
wow.
even like a hundredth of a share. It lowers the barrier to entry for people who don't have like a ton of money to invest up front.
That's such a game changer.
It is.
Especially for younger investors or people who are just, starting out. Okay, so you've got your brokerage account, you've done all your research, you're ready to buy your first stock. But how do you even choose what to invest in?
Right. There's like thousands of companies out there.
Yeah, where do you even begin?
Well, I love this advice that Jordan gives. He says, invest in what you understand. What are you interested in?
Makes sense.
Think about your hobbies, your passions, things you already spend your money on. Are there companies that align with those interests?
So if you're like a coffee lover, you look into Starbucks, or, if you're passionate about sustainable living, maybe you research renewable energy companies.
Exactly. That way, even the research is fun, right?
Yeah.
Once you've identified some companies that, kind of resonate with you, there are great tools out there, like Yahoo Finance. It can help you analyze market trends,
Okay.
company performance, compare different stocks. You can see things like a company's earnings, revenue, debt levels, all that good stuff.
You're basically like putting detective, right?
Yeah.
Gathering evidence to see if a company's worth investing in.
Exactly. It's not just about the numbers, though. Jordan emphasizes qualitative factors, too, things like brand reputation, customer loyalty, their overall innovation pipeline. These are harder to measure, but they're equally important for long-term success.
Makes total sense. But what about all the hype we see around certain stocks, right? Sometimes it feels like everyone's talking about the same company. How do you avoid getting caught up in that and just like impulsively making a decision?
Well, Jordan cautions against relying solely on hype or what other people are saying. He's all about, thinking for yourself.
Okay.
Just because a stock is trending on social media doesn't mean it's a good investment. Do your own research. Trust your own judgment.
It's like that classic, if everyone else jumped off a bridge, would you? Don't just follow the crowd. Okay, so we've covered a lot, from the basic definition of the stock market to choosing your first stock. But there's this one crucial element we haven't touched on yet.
Okay, what's that?
Risk management. Like everyone wants to make money, right? But what about the potential for losing it?
Yeah, absolutely. That's a reality in the stock market.
Big time.
And this is where Jordan's insights become even more crucial. He doesn't shy away from the potential for losses. He talks about the traps investors fall into, like making emotional decisions based on, fear or greed.
Yeah, yeah, like panic selling during a market dip.
Exactly. It's like selling your produce at a discount just because, a couple people left the farmer's market.
Totally. Fear can lead to some not great decisions.
Yeah, and then on the flip side, overconfidence can be just as dangerous. Thinking you could like always outsmart the market is a recipe for trouble.
So how do we avoid those pitfalls? What does Jordan say about this?
Well, he talks about the importance of having an exit plan.
Okay, I like that.
This is something a lot of beginners overlook. So an exit plan means knowing when to cut your losses if a stock starts tanking.
Yeah.
It's about setting like predetermined thresholds for selling so you're not just making decisions based on, your emotions in the moment.
So basically, before you even buy a stock, consider that worst case scenario. Like, what if this investment goes south?
Right.
How much am I willing to lose?
Exactly.
Okay, that's great advice. Having those boundaries in place can really help. And he also mentions the importance of considering, like, the worst case scenario, right?
He does.
Which, it might seem pessimistic, but it's a prudent approach.
Totally. Before you invest, ask yourself, what's the absolute worst that could happen with this investment? Can I handle that?
It's about being prepared.
Yeah, mentally and financially.
Okay, so we've talked about, like, the emotional aspects of investing, the importance of having a plan,
Right.
managing risk.
Yes.
Let's circle back to the practical stuff. We're ready to buy our first stock.
Okay.
How do we actually choose? Jordan gave us that great advice about investing in what you understand, but are there any other like practical tips that he shares?
Yes. He goes into like, the actual research process
Okay.
and how to really evaluate a company's potential. So he emphasizes using tools like Yahoo Financed to analyze those market trends we were talking about,
Okay.
track company performance, compare different stocks. So you can see things like a company's earnings, their revenue, debt levels, and how the stock prices, performed historically compared to its competitors.
So we're talking like looking at spreadsheets and charts.
Yeah, yeah. But he cautions against relying solely on the numbers. He stresses that qualitative factors are equally important.
Okay.
Things like brand reputation, customer loyalty, and their innovation pipeline.
So we're not just looking at numbers, we're looking at the company's story, their culture,
Exactly.
their potential for future growth.
Exactly. It's about, the whole picture. And Jordan also warns against getting caught up in the market hype. Just because everyone is buzzing about a particular stock doesn't mean it's a good investment.
Don't believe everything you read on the internet, right?
Exactly. Do your research, think critically, trust your gut. Sometimes the best investments are those ones that fly under the radar.
Oh, interesting.
Companies that are poised for growth but haven't yet, caught the attention of the masses.
So it's about like finding those hidden gems.
Yeah, yeah.
But even with all the research and analysis, isn't there still so much uncertainty?
There is. There is.
In the market, I mean, you can't predict the future, right?
No, you can't. And that's why Jordan emphasizes having that, long-term perspective. The market will always have its ups and downs, but over time, companies that are fundamentally sound and well-managed tend to perform well.
So it's about staying focused, being patient, and not getting spooked by those like short-term fluctuations.
Precisely. And as Jordan wisely says, investing is a continuous learning process.
Oh, for sure.
The market's constantly evolving, new trends emerge, companies, rise and fall. It's essential to stay informed, adapt to those changing conditions, and never stop learning.
So even seasoned investors are still students of the market.
Always. Always learning. There's always something new to learn, new strategies, new companies to discover. The stock market's this dynamic and fascinating world, and the learning never truly ends.
Welcome back to our stock market deep dive. We've got a solid foundation. But Jordan Lee, he points out this whole like psychological side of investing that we need to unpack.
Right. It's fascinating how he emphasizes that, successful investing, it's not just about picking the right stocks. It's about managing your emotions.
Oh,
The
yeah.
market, it could be a real roller coaster.
Absolutely.
You'll have your ups, you'll have your down, exhilarating highs, gut-wrenching lows. It's all part of the game.
Totally, totally. We're human after all. Like it's easy to get caught up in the excitement when, the market's soaring, and just as easy as like panic when things start to go down.
Yeah, exactly. And Jordan talks about having, a solid investment plan and sticking to it even when the market throws you a curveball. It's about, making rational, informed decisions based on your long-term goals, not letting those emotions, those fears and greed kind of dictate your actions.
Okay, that makes total sense. But how do you actually like develop that kind of discipline? Like it's one thing to say don't panic, but it's another to actually stay calm when you see your investments dropping in value.
Right. Well, one strategy that Jordan suggests is, to really focus on those fundamentals. Do your research, really understand the companies you're investing in, and have a clear understanding of why you're investing in them. This knowledge can really help to keep you grounded when things get turbulent.
So you're saying if you truly believe in like a company's long-term potential, a short-term dip in the market shouldn't necessarily make you sell?
Exactly. It's about looking beyond those day-to-day fluctuations and focusing on, the bigger picture. And another crucial strategy Jordan highlights is diversification, which we touched on earlier with ETFs and index funds, but it's worth reiterating.
Yeah, the whole don't put all your eggs in one basket idea.
Exactly, yeah. Spreading your risk across different industries, asset classes, even geographic regions can act as like a buffer against that market volatility. So if, one sector, one company takes a hit, your entire portfolio isn't going to be decimated. It's like having a safety net for your investments.
That's a great way to put it. So it's about like building a portfolio that can withstand those ups and downs.
Yes.
But speaking of withstanding the downs, how do you know how much risk you can actually handle? Because that's got to be different for everyone, right?
It is, and Jordan, he addresses this by talking about risk tolerance, and it's a personal question. There's no right or wrong answer. It
Okay.
depends on your financial situation, your investment goals, how comfortable you are with the possibility of losing money.
So if say you're young and you have a longer time horizon before you need to actually like access your investment, you might be more willing to take on, some risk hoping for those higher returns down the road.
Exactly, but someone closer to retirement might prefer a more conservative approach. Focusing on preserving their capital and generating income.
Okay, that makes sense. But even if you have a higher risk tolerance, I guess it's still important to remember that no investment is completely risk-free.
Right, right. And that's why Jordan emphasizes, having that exit plan. So what's your strategy if a stock starts to tank, right? At what point will you, cut your losses and sell? Having that plan in place can really help you make those tough decisions without letting your emotions cloud your judgment.
So it's like having a safety valve to prevent things from, like spiraling
Exactly.
out of control. He also mentions like, considering that worst case scenario, right?
He does, and it might seem pessimistic, but it's actually a very, very prudent approach. Before you, invest in anything, ask yourself, what's the absolute worst that could happen with this investment? Could I actually handle that loss?
It's all about being prepared
Yeah,
mentally and financially.
exactly. Investing, it isn't just about, chasing those potential gains. It's about managing those potential losses.
Yeah.
It's about finding that balance between risk and reward.
So we've talked about the psychological aspects of investing.
Yeah.
The importance of, having a plan, managing risk.
Yes.
Let's get back to the practical side of things, right? We're finally ready to buy our first stock, but how do we actually choose? Jordan gave that great advice, invest in what you understand.
Yeah.
But are there any other like practical tips that he shares?
Yes. He dives into the actual research process, how to really evaluate a company's potential. He emphasizes using tools like Yahoo Finance to analyze those market trends we were talking about,
Okay.
track company performance, compare different stocks, so you can, look at things like a company's earnings, their revenue, debt levels, and how the stock price has performed historically compared to, its competitors.
So we're talking looking at spreadsheets, charts, all that.
Yeah, but he cautions against relying solely on those numbers. He stresses that those qualitative factors are equally important,
Okay.
like broad reputation, customer loyalty, and their innovation pipeline.
So we're not just looking at like, spreadsheets and charts. We're looking at the company's, story, their culture, their potential for future growth.
Again, it's about understanding that whole picture. And Jordan also warns against getting caught up in the market hype.
Oh, yeah.
Just because everyone's buzzing about a particular stock doesn't mean it's a good investment.
It's like that old saying, don't believe everything you read on the internet.
Exactly. Do your own research, think critically, and trust your own judgment. Sometimes those best investments are the ones that fly under the radar,
Oh,
those
interesting.
companies that are poised for growth but haven't yet, caught the attention of the masses.
So it's about finding those hidden gems, those those diamonds in the rough.
Yeah, yeah, exactly.
But even with all the research and the analysis, isn't there still a lot of uncertainty?
Oh, absolutely.
Like you can't predict the future, right?
No, no, and that's why Jordan really emphasizes having that long-term perspective. The market will always have its ups and downs, but um, over time, companies that are fundamentally sound, well-managed, they tend to, perform well.
So it's about, staying focused, being patient, not getting spooked by those short-term fluctuations.
Precisely. And as Jordan wisely says, investing is a continuous learning process.
For sure.
The market is constantly evolving, new trends emerge, companies, rise and fall. It's essential to stay informed, adapt to those changing conditions, and never ever stop learning.
So even seasoned investors are still like, students of the market.
Always, always. There's always something new to learn, new strategies to explore, new companies to, discover. The stock market is this dynamic, fascinating world, and the learning never truly ends.
Welcome back, everyone. We've covered so much ground already, from the real basics of the stock market to those, psychological traps
Yeah.
that can really kind of mess with our heads.
Yeah.
But Jordan Lee, he also mentions some strategies in the podcast that are, a little bit more adventurous.
Right. Yeah.
He acknowledges that while long-term investing is, generally recommended for most people,
Yeah. Especially beginners.
there are, other approaches out there for, people who are interested in more like active training.
Yeah. Yeah. He talks about technical analysis as one example.
Okay, technical analysis, that sounds a little intimidating. Break that down for me.
Okay. So think of it like this. If fundamental analysis is about, understanding a company's like inherent value, its fundamentals,
Yeah.
technical analysis is more about studying charts, patterns, market trends to try and predict those future price movements.
Okay, so instead of like, digging into the financial statements, you're looking for clues in the stock's like price history.
Yeah. Traders who use technical analysis, they look for indicators, things like moving averages, trend lines, chart patterns to identify potential buying or selling opportunities.
So it's like a much more short-term approach compared to those long-term, buy and hold strategies that we talked about earlier.
Yeah, it is. And Jordan cautions that, technical analysis, it shouldn't be taken as gospel.
Yeah.
It's just one tool in a trader's arsenal, and it should really be used in conjunction with, other forms of analysis, including fundamental analysis.
So it's not about like, abandoning everything we've learned about evaluating companies. It's about adding another layer
Yeah.
of analysis to kind of maybe, refine those trading decisions.
Exactly, exactly. It's about combining those different perspectives to get a more comprehensive view of the market. And another advanced strategy that Jordan mentions is value investing, which is all about finding those hidden gems, those companies that the market has maybe overlooked.
Ah, value investing. So that sounds like bargain hunting in the stock market.
In a way, it is. Value investors, they look for companies that are trading at a discount to their intrinsic value.
Okay.
They believe that the market doesn't always accurately reflect, a company's true worth, and so they seek to capitalize on those discrepancies.
So it's like finding that amazing vintage dress at like a thrift store for a fraction of what it's actually worth.
Yeah, that's a great analogy. But just like, finding those hidden treasures takes time and effort. Identifying undervalued companies, it requires a lot of research and a lot of patience.
Yeah.
Value investors, they pore over those financial statements, analyze industry trends, and really assess a company's management team to determine its true potential.
It sounds like, it takes a certain type of investor, someone who's really willing to, do that deep dive and wait for those opportunities to kind of emerge.
It does. But for those who are patient and have that long-term perspective, value investing can be incredibly rewarding.
Okay, so now on kind of the other end of the spectrum, Jordan also talks about growth investing, and that seems like pretty different from value investing.
It is. So while value investors are looking for those bargains, growth investors, they're searching for those companies that are poised for explosive growth even if their current valuations seem, a little high.
So they're looking for those future like superstars, those companies that are, disrupting industries, innovating at a rapid pace and really capturing that market share they're willing to pay a premium for that potential.
Exactly. Think of companies like Tesla or Amazon in their early days.
Yeah.
Growth investors saw their potential and really rode that wave of phenomenal growth, even though their stock prices might have seemed, expensive at the time.
But I imagine growth investing comes with its own like set of risks as well, right? Like not every, high growth company lives up to the hype.
That's true. That's true. Not every promising startup becomes the next Amazon, some flame out, pretty spectacularly. So growth investing, it requires, careful analysis and a willingness to accept, higher volatility.
Higher risk, higher reward.
Potentially, yeah.
Okay. So we've got technical analysis, value investing, growth investing. It seems like there's so many, approaches to kind of navigate the stock market.
There are, and the key, as Jordan emphasizes, is to find an approach that really aligns with your investment goals,
Yeah.
your risk tolerance, and the amount of time and energy you're willing to dedicate to managing your investments.
It's like choosing the right, hiking trail. Some
Mhm.
people prefer like, those leisurely strolls, while others they crave those challenging climbs.
Right, right.
It all depends on your individual preferences and capabilities.
That's a great way to put it. And no matter which path you choose, Jordan, he reminds us that investing is this continuous learning process.
Oh, sure.
The market is always evolving. New trends emerge. Companies, they rise, they fall. It's essential to stay informed, adapt to those changing conditions, and never stop learning.
So even like seasoned investors are still like students of the market.
Absolutely. Always. There's always something new to learn, new strategies to explore, new companies to discover. The stock market is this dynamic, fascinating world, and the learning never truly ends.
Well, I feel like we've covered so much in this in this deep dive,
We have.
but I also feel like we've only just scratched the surface.
Yeah.
There's a whole, universe of information out there about this.
There is, and that's the beauty of it. Investing can be this lifelong journey of discovery and growth, both, financially and intellectual.
Jordan Lee's Stock Market Basics has given us such a fantastic foundation,
Yeah.
and I'm excited to keep exploring, keep learning. As we wrap up, is there any like final advice from Jordan that you think is particularly important for our listeners to remember?
I think one of his most powerful points is the importance of emotional discipline.
Yeah.
We talked about it earlier, but it's worth reiterating. The market will always be unpredictable, and there will always be those temptations to kind of react impulsively. But by developing a clear plan, understanding your risk tolerance, and really focusing on the long term, you can minimize those emotional swings and make more rational decisions.
That's such valuable advice. It's so easy to get, caught up in the excitement or the fear, but ultimately it's about staying grounded, sticking to your strategy and not letting your emotions, derail those financial goals.
Exactly. Investing should be a journey that empowers you, not one that stresses you out.
Well said. So, to all our listeners out there, we hope this deep dive has equipped you with the knowledge and the confidence to start your own, investing journey.
Yeah.
Remember, it's not about getting rich quick. It's about making those informed decisions, staying disciplined, and really, enjoying the ride.
And never stop learning. There's a whole world of financial knowledge out there waiting to be explored.
That concludes our deep dive into the stock market. We hope you found it insightful and, dare I say, even a little bit fun.
A little bit.
Until next time, happy investing, everyone.